Real estate is a great investment. It offers consistent cash flow, excellent returns, and adds diversity to your investment portfolio. Especially during times of high inflation, real estate is a great asset to add to the mix. But buying an investment property or operating one on your own can be pretty expensive or time consuming, depending on how you're doing it. Today, I'm talking with the Kitti sisters, two inspiring entrepreneurs who have made investing in real estate simple and passive through what we call a syndicate. If you've been curious about how you can get into real estate investing without actually finding a building or managing it yourself, stay tuned. We've got answers for you. Hello and welcome. So I am super excited to be here with the Kitti sisters today talking about real estate investment. So before we get started, I'd love for you two to just tell us about yourselves and what it is that you do.
So I'm Nancy and Palmy, and together we make the Kitti sisters. So we help high-level entrepreneurs disconnect income generation from time through apartment investing.
So basically, a little background on us is like, as we were growing up, we watched our parents work really long hours to provide for us. And so they did a really good job to make sure that we had food on the table and that we had a comfortable place to sleep at night. But the part that they were missing is that they really weren't present in our lives. And so they were spending a lot of time at work. And so they miss a lot of the typical events that you'll go through, in your adolescence, like school open houses, sporting events, even some
even graduation,
yeah.
Right? Like for us, we believe that time is only
the only currency,
our true currency.
We were kind of all of a sudden started living that same path, even though we're like, hey, they were, not able to spend a lot of time with us, but then like we felt in the same trap. And so when we started working,
so we kind of got into the same hustle culture that like our parents. So when we entered the fashion manufacturing world and when we had like an overnight loss of 95% of our income, and that was our only source of income, we decided enough is enough. And then that's when we entered the real estate investing world.
So like most people who enter real estate, we started flipping houses and it was making good money in Southern California, but we realized we were still trading a lot of time for money. And so we knew that like, that's not a good way to do things. We discovered that like,
that's a no-no for the Kitti kingdom, right? So we thought, okay, how do we magnify the output with small input? And that's how, like doing the least and get the most out of it. And that's enter apartment syndication. So we learned quickly that, hey, in life, how do you learn how to magnify output with small input? And in this case, the sweat equity, AKA your effort.
And that's why we love helping our passive investors generate passive income while they can maximize their money. These type of investment opportunities basically allows you to sleep, eat, play with your kids while your money is making money. And that's a super beautiful thing to have.
Sounds like a dream. Yeah. So separating time from money, kind of getting your time back while still making passive income on the side. I mean, sounds too good to be true. So can you explain, to the layperson, to the person who's never heard of apartment syndication before, what is that? What is apartment syndication?
Yeah, so basically for most passive investors in real estate, they would start out with like single family homes. They'll have a couple properties that they rent out, maybe a duplex, triplex, or something along those lines. But what they typically will end up with is like they're going to run out of down payment money, or they're going to not be able to do the financing option because each person is limited to 8 to 10 loans that they can sign on for. So those are some of the downfalls that they'll end up having and they'll see through the process.
Yes. So they can either sit back and say, hey, I'm good just with my rentals, or they can step up to the challenge, right? And they keep going by, and they see more deals. And that's when apartment syndication comes in, because a whole lot of people also experiencing that issue. And then what they do is they get together and, where a group of investors pull in either resources like capitals, relationships, energy, and time and expertise, and they come together and they go after bigger deals. And for us, the Kitti sister, we always recommend,
65 units or above as larger deals because we have economy of scale at that size. And so that's really where you're really truly passive, where you're actually approaching things instead of linear. It's going to go more exponential because time input, effort input is minimal, but the output is significantly larger. And that's how people go bigger and faster, because we really believe the saying that wealth has a need for speed.
Yes.
Yeah. So back up a minute. So there's a couple different ways to invest in real estate. One is buying a home, holding on to it and selling it.
Mhm.
Another would be buying a home, improving it, and then trying to sell it quickly for more than you bought it.
Yep.
Then there's kind of like big in commercial investing, or real estate investing at a bigger level where you're buying apartment buildings or you're buying commercial buildings. But
Yes.
the price tag on those is all going to be probably $1 million or more.
Yes.
So apartment syndication seems like this fourth option where people can pool their money and get a piece of an apartment building, you're saying.
Right. Yes. So basically it's putting a small piece of your money, but now instead of buying like a fixer upper or something that's not in really top not shape, not in really good demographic, you're going to buy really high caliber properties that are like institutional levels. So for example, our last purchase was a $71 million property in Houston, Texas, built in 2016. Now that's like institutional quality. Instead of going to like a submarket, maybe try to buy something for a couple million.
Yes.
And
And
how are you? Oh, go ahead.
oh no, and in addition, like it's truly passive, mean like they don't even have to lift a hammer or even a paintbrush. They don't have to deal with like tenant like rowdiness or anything like that. The apartment syndicator and their team, they take care of that. So you truly like sit back and relax and just, you can sip Mai Tai in Bora Bora and just enjoy life.
Yeah.
So how are you selecting the markets and the apartment buildings?
This is a really important question, and we get this asked all the time, especially now where you can see that inflation is really high, interest rates really high. So you have to be more selective. The market's not going to help people who are careless. So for us, we have a little black book of 4 different types of metrics that we use to evaluate the areas that we're going to invest in. So the first one then
is like actually we have to look at the net migration, right? And this is an important numbers in like certain areas.
Yeah, so basically net migration really tells you the story of supply and demand. You want areas where people are moving to. You don't want areas where there's a decrease in population. And so when we look at this, we're looking at homegrown migration, meaning like people who are just having more kids and living there, and like people moving from out of state. And you can see example like Phoenix or Dallas, Fort Worth, Houston, Texas. These are areas where people are moving to.
Yes. And net migration kind of go hand in hand with job growth, right? So why do you think like people relocating? And they could be for very different reasons. Some move for closer to university, colleges, family, jobs, and stuff like that.
But the most important direct correlation that we see with job growth is they're moving because that helps with like the areas that we're going to pick, because that shows strong supply and demand imbalance. Okay, number 3 is really it has to do with affordability. We want to go into areas that people cannot just afford rent that we have now, but also afford the rent increases.
Yeah.
Because apartment investing is a very simple business. Decrease expenses, increase rents, income, and then you make a whole bunch of profit. So
yes, and that how you calculate this metric is by looking at like the inventory and also the pipeline in construction, right? You want to know like, hey, in 2 or 3 years, is there going to be
oversupply, overbuilt in the area? Because we can have a supply imbalance on our favor now, but if there's a whole bunch of new development happening within a couple miles, and that's a bad sign, obviously.
And of course, the last matrix is to look at is vacancy.
So basically, vacancy rate really tells the story of that specific property, because we want to make sure that people are paying rent and they're happy to live in this area. Typically, we go for physical vacancy no higher than 8%. Yeah. So
higher than 8%.
Yeah. So basically, occupancy should be around at least 90 to 92% and above.
Mm-hmm. Okay.
Yeah.
So that makes sense. So, so let me put it in terms for the average person to kind of walk through the process. So you would use these 4 factors. You'd identify this apartment building in Dallas because it's a growing city with jobs and high occupancy.
Yeah.
So people can, because there are jobs, people are probably going to have higher incomes and might be able to afford the increase in rent.
Yes.
You pool a bunch of money from your investors. So people are contributing money from all over the country. You buy the $71 million apartment building.
Mm-hmm.
I can make some assumptions about what you're doing next, but tell me then what you do as the investors or as your property management team. What's the next step to both lower your costs and increase your rents?
So this kind of happens at the very beginning before we even buy the property. Of course, we come in with a business plan. So prior to purchase, as we're doing our due diligence, part of that is surveying the immediate area, walking our property, but also the comp properties to see what are the amenities that other properties have that maybe we're lacking, or areas where we feel that we can increase other income. Now, for example, if you're walking a property A class, typically people want washer and dryers inside their units. And a lot of times, like maybe the connections there, the hookups there, but they're not charging that. That could be a $50 to $75 bump in rent per month just there. In A class, you can do valet trash pickup. You can do like reserve parking, covered parking. You can do
tech packages,
which are like internet packages. You can do like electric car charging stations. In some properties, you don't even short-term rent out like Teslas. So depending on where you live. So those are some of the factors that we consider before we take over. And so
those are services that you're adding on to the building.
Correct. So there's two types of income that we're generating. The rental income, which is just what we'll call rent income, and the other is other income. So the other things that we're talking about are incorporated in that. And really important is like when we survey the market, we need to make sure that the things that we're going to add are what people are in this area are actually willing to pay for. If we overbuild and that's not what the market calls for, then we're wasting money and we're not going to be able to achieve that growth.
Yes, and in some like apartment complexes, we actually didn't have to implement the business plans for the other income due to the organic rent growth. We are able to like push up rent organically as is, so that we save on the rehab renovation costs.
Wow. And what are the ways that you're reducing costs?
Yeah, so the simplest way, most of the time when we go into a property, what we notice is that there's a management inefficiency. So this can happen very simply by having an out of town owner who isn't really paying attention to this property, or they have a bad property management team on site. Property management plays probably like 50 to 60% of the role in how the property is going to perform. Of course, we as asset manager guide that, but if the people on the ground are not doing the work to push the rent, to walk the unit, to encourage people to pay, etc., then it's going to be more harmful. So yeah, so those are kind of the stuff that happens.
So you would come in and replace the management team?
Typically we'll replace the management team, and sometimes we'll see like, hey, the water is the fixtures that are used is like using so much water out of the property, and maybe it's an all bills paid property where we pay for utilities and water and gas. So we may go in and change out all the fixtures. There's a water conservation package that we can change toilets, faucets, everything like that. So that sometimes the saving can be like $200,000-300,000 per year. And that can result in a couple $1 million valuation increase.
Yeah. And a positive impact on the environment, all that.
Yeah, absolutely. And there's also loan packages. Fannie has some stuff that's our like energy green. They call it the green program, where if you change out certain light fixtures and make the property more energy efficient, they'll actually give us better loan terms for that.
Oh, amazing. Love that.
Yeah.
Cool. So what is, the average person? So, there's someone in California who wants to invest in this apartment building in Texas.
Yeah.
How are they supposed to evaluate whether or not that makes a good investment? How do they decide to join the Kitti sisters in a syndicate or some other company in their syndicate? How do they make that decision?
Well, there's a lot to consider before deals are closed and checks are cashed, right?
Yeah. So like the thing that we want to stress is that, real estate investing is dangerous if you don't learn how to mitigate risks.
So we come up with a simple and effective strategy that gives you total confidence in all your money and investing decision. All you have to do is care.
So it's care. So CARE is the acronym that we use to give people a really simple guide on how to kind of like filter through deals.
Yes. So C stand for compass, right? In order to achieve any goals, you must have predefined investment criteria on how to measure the result. Your, actions, like using a compass
Yeah, you
as
have
a
to
guide.
know that ahead of time. And the second thing you need to know inside of compass is the freedom metric.
That's what we call, right?
We call it the freedom metric, the number that you need passive income to be generated monthly so that you don't have to worry about your monthly expenses. So this means that with or without you trading more time, you're going to be able to support the current lifestyle that you're living. Yes. And then the second point is A. So A in CARE stands for awareness. And this is basically what we kind of talked about earlier. It's like understanding the property's location, the demographic, the median household income, who are the major employers in the area, rent growth projections, and kind of like that overall demographic profile.
Yes, and up is R, which stands for review, right? Or do your own due diligence. When when you do apartment syndication, you actually have to know so much, like you have to know the numbers, but more importantly, you have to learn how to vet the deal sponsor. As you said, like there's so many out there. Who do you trust, and who do you give your money to?
Yeah, because this is like a lot of, you're putting your hard-earned money into these deals, and you need to make sure that you're doing it with the right people. I think like for Nan and I, through our experience, we, even as passive investors, we learned that two deals can be completely identical. If you invest with the wrong sponsorship team, they can run that deal to the ground.
Yeah, so choosing the right team is everything, right?
Yeah.
And like how we said, it's kind of like find your Hogwarts
Yeah.
squad, right? That is
like Harry Potter couldn't do it by himself. So,
yeah. So you may not be an apartment syndication expert, but your team must be an expert.
Yeah. This
right?
cannot be a side hobby, can't be a side hustle. This has to be their full-time job. These are really large properties.
Yes. To clarify, it has to be the sponsor's full-time job, not the investor.
No. The investor, they can.
So the investor due diligence is on the sponsorship team, and that's where they vet, because the passive investor, we're like, you're busy doing your,
it's a job of the sponsorship team to actually do all the things that we stated. Now it's your job, once they provide those information, to
vet,
sort of validate if it makes sense. And they're super simple things that you can search online for these properties.
And finally, E, which is execute, right?
So like a lot of time what we notice is that people keep dotting their I's, keep crossing their T until they're blue in the face, and they keep it theoretical. They don't do anything, and they just succumb to like analysis paralysis.
Yeah. So Tony Robbins said the path to success is to take massive determined action.
So the Kitti sisters, we actually say the path to success is determined by the speed of implementation.
So the Tony Robbins, the Kitti sister, basically the same thing. Hey, just take action.
Yeah. So the thing is, like we said earlier, these components, it sounds like a lot of research, but if you work with the right sponsorship team, it's their job to already have all this information and provide you the detail. Your job is just to verify that it makes sense.
Yes.
And so let's talk about that specifically. How do you verify that it makes sense?
Where
does the due diligence of the investor come in?
So the first part is, I think, like data, as you know, is as good as the people who are providing it. So first thing is, you need to know that the people who are providing this information, you can trust them.
So you need to know like their track record, and most importantly, it's like kind of like your interview for a job, like someone for a job. You need to kind of go through your internal interview process and say, hey, like I'm trusting you with some of my money. You're not going to invest all your money and put your egg in one basket. You're gonna like, hey, let's see if this is something that, hey, can help step up my real estate profile.
And as far as like those demographic numbers, it's super easy to Google these things. It's everywhere. Like you can Google and find out, hey, what are the top net migration? Like U-Haul typically comes up with a report that talks about how that is a correlating, like U-Haul trucks going to a specific market correlates with net migration growth. And then we can just tell you simply like Dallas, Fort Worth, Houston, Texas, Austin, Texas, Phoenix, Georgia, the Carolinas. These are some of the markets that have super strong net migration.
Mm-hmm. Awesome.
Yeah.
So it's kind of trusting, learning, getting to know the sponsorship team and their track record, and looking at buildings they've done this before and maybe how they've resulted in the past. And then your own research on the market and see if that's a market that you believe in.
Yeah. And if you Google the name of the property, you can see the information. Apartment.com is it's free, and it's like you can see all the pictures. You can see like similar properties, because typically they'll suggest like, hey, there's something close, and you can see, hey, are the prices what they're saying they think they can get.
Yes. And also like the business plan has to be really simple enough to implement. If it's something that like, oh my God, it's going to take like forever to implement, then you probably won't want to invest in that deal. Not saying it's not good, but it may take longer or harder to implement.
Yeah.
Mm-hmm. What are some example returns that your investors have gotten in investing with you?
Yeah, so our track record is actually in 23.5 months, we are able to deliver 2.85x equity multiple to our investor. Of course, no
Like,
investment is
guaranteed,
guaranteed.
and past results does not guarantee future performances. So,
But that's just our track record.
but in general, what we try to aim for as a projection is 5 years, 100%, 100% return. So basically, like
if you put in 100,000, you're going to get 100,000 back as the original principal plus the profit. And the profit is split between cash flow, 50% most likely, and the sale of the profit.
Depending on the property.
Yes, because you're participating as an equity partner. So you get the benefit of, when we profit on the sales.
So just to play that back for our listeners, they would invest $100,000 and then once the business sells, they get their return?
No, so there's two parts. So the first part is cash flow. Basically, the income that the property produces, we do quarterly distributions.
Okay.
And it's per deal. There'll be different projections that we do. Sometimes we'll exceed it. Sometimes we'll be a little bit under, but on balance, we've done better than we projected. And then, so that's part of the profit. And the second part is we only hold these properties for about 3 to 5 years. As Nan said, we've averaged less, but the underwriting is for 3 to 5 years. And so therefore, after 5 years, they'll typically combine cash flow plus the appreciation, hit the 100% return.
Fantastic. So what is the minimum to invest and who is eligible to invest with you?
Yeah, so actually, the minimum to invest with us right now is 75,000 per the investment opportunity.
Yeah, so typically there are sponsors who can go like 50 or 100K or even higher. So it depends on who the sponsorship team is.
And also depend on each deal, right?
Yeah.
So I mean, like the deal that we just did, $71 million, we raised over $33.6 million, so we take higher minimum because we want to deal with less.
We want to be able to service our investors, serve them. And if we have
more,
if we took $1,000, for example, we wouldn't be able to be as connected to them. Yeah. So because we're always available to talk to them, respond to them. Now, the other part, like who qualifies, that's a really good question
to invest with us.
So our investments are through the SEC's regulation 506B. So what this means is that we can take both accredited and sophisticated investors. We can take up to 35 sophisticated and unlimited accredited investors. But the thing is, we have to have a pre-existing relationship with them. Meaning, for example, we can't come on this call and say, hey, I have a property that I want you to invest in and send me your money. Can't do that. But if we talk on this call and you're like, hey, I like the idea of the things you're doing, like put me on your investor list. From there, we can solicit you the deal.
Yes. So we have what we call like the Kitti Freedom Club, where we hand select and also pre-vetted a deal for our investors, and all they have to do is just do their own due diligence. And I want to go back a little bit and explain what is like
an
accredited investor and sophisticated investor.
So under that regulation D 501, it's a Securities Act from 1933. Basically, an individual has to have an income over 200,000, or if they're a married couple, 300,000 to be considered accredited. Or their net worth needs to exceed $1 million for one person, for a single person, not counting their primary resident,
or a couple,
or 2 million if it's a couple. Also, if it's a business entity, the entity needs to be worth more than 5 million, et cetera. So
that's an accredited investor.
That's
and you can have
accredited.
unlimited accredited investors.
Correct.
And then you can also have sophisticated investors who have a prior relationship with you.
Correct.
So both have to have
prior
because due to under 506B, both have to have pre-existing relationship. And sophisticated investors, they do need to have like in-depth knowledge of investments, such as like stock market or even like
single family home that they've had or they've studied the topic. It's self-verifying, so it's up to the person to decide if they are sophisticated or not. There's no like right or wrong.
But they just know that there are risks involved,
and they're comfortable taking that risk, understanding what we're doing.
Investments.
Okay, so let's say we have a sophisticated investor listening who wants to put $75,000 into your next project. When does it make sense for someone to add real estate to their investment portfolio?
Well, we would like to say since yesterday.
So I just actually heard a talk by Larry Summers, who was the Secretary of Treasury during the Clinton administration like a couple of days ago. He said, especially during high inflation period, it's always a really smart idea to have real estate as part of your portfolio, especially income producing, because we're a hard tangible asset that is hedging, but also not even just hedging, we're beating inflation. Our returns are better. And also at the same time, there are tax benefits that outstrips a lot of other type of investments. So for us, you should always have a part of your investment in real estate.
Do you have a specific percentage that you recommend?
So basically, we like to invest wherever the investment follow inflation. So not particularly like
we don't have a percentage, but of course, like we're going to lean way heavy real estate because that's our preference. But we do invest in other things as well. But basically, it's kind of like a personal choice at that point.
Absolutely. Yeah. Some people say just invest in what you know. So if you know real estate, just go all in real estate.
Yeah. I would say like you have to have some sort of a balance as well, because real estate is an illiquid investment versus like stocks or something like that.
Mm-hmm.
So.
But ideally, when we teach investing in the stock market, we're teaching people to do it for the long term. So
yes,
minimum. So it's similar.
Yeah, not like day trading, not minute trading.
Not day trading. No. Fantastic. This has been so informative. I'd love to know if someone were interested in investing with you, where would they go to learn more?
Yeah, so basically they can go to connect with Kitti with an I. So again, connect with Kitti, KITTI.com. And then they can sign up and get a little bit more information. They can schedule a call with us. Again, we all have to have pre-existing relationship with a person. So it's a step. You have to call us and
yes. And then, or they can tune into our podcast, drop twice a week, Cash Flow Multiplier podcast, where we share tips, tricks, and secret in owning your own time.
Awesome. Well, thank you so much. This has been such an inspiration. I hope our listeners are feeling excited about the prospects of real estate. And it's really nice to have you on our YouTube channel. Thanks for coming.
Well, thank you so much for having us. It's been really fun.
Thanks so much for joining us. I hope that helped you learn about your options when it comes to real estate investing. If you're interested in learning more about the Kitti sisters or investing with them, I'll leave links in the description below for you to explore. You can also check out other videos we've done on real estate investing. I'll link to those below as well. As a reminder, we publish YouTube videos on how to save, invest, and make the most of your money every Monday. So be sure to subscribe and hit the bell so you don't miss out on future videos. And if you liked this video, be sure to give it a thumbs up so we know to make more real estate content in the future. See you next time, and thanks so much for watching.